Right, heading into the new year, there are both risks but also potential opportunities in the mining sector. Joining us now to discuss is Craig Hutchison, Director of Equity Research at TD Cowen. And for full disclosure on companies covered by TD Cowen, a division of TD Securities, please see the link to the website at the end of this video. And Craig, thanks for joining us.
Yeah, thanks for having me back on the show.
All right, well, let's start with the potential headwinds for the mining sector from a new Trump administration. What are you seeing there?
Yeah, certainly, he's been pretty adamant about bringing in new tariffs. Tariffs both on Canada, Mexico, and I think the biggest concern for the mining industry is more tariffs on China. So increasing tariffs up to 60% on Chinese goods. China is the largest consumer of base metals in the world. In many cases, like copper, they consume over 50% of the world's copper supply. So anything that kind of dampens global bilateral trade is not good for base metals. There are certain things can offset that. You would have seen China talk recently about the potential for stimulus. They're using language around loose monetary policy, which for them is some of the most aggressive monetary policy they've talked about, I think, since the global financial crisis, almost 15 years ago. So that could obviously bode well for domestic demand for China if Trump does follow through with the tariffs that he's talking about. So there are some obviously offsets there we can talk about.
Maybe we could dig a bit into that because, of course, Trump has said he will target China with tariffs, and when it comes at a time when Beijing is really trying to stimulate the economy, as you mentioned, just today, as you talked about, the Politburo has said that it will adopt an appropriately loose monetary policy next year. So, the big question is, what impact will this have on metal prices going forward?
Yeah, we've already seen a positive reaction. We saw it yesterday in the trading where copper prices and base metal prices were up. It's obviously very important. So the Chinese economy has struggled in the last couple of years because the property market, which was such a huge part of the economy, I think is around 25% of their GDP. That has been suffering. It's been around down 20% or so new demand for properties. So to offset the weakness that they're seeing in the property market, they've turned to the export market, and they've also turned to sort of domestic stimulus. So the government has spent a lot of money on infrastructure. I think that's something that they'll continue to do next year. That's something that they can control internally, is focusing on domestic infrastructure and construction within the country. It's more difficult for them to focus on exports if obviously some of their partners like the U.S. and stuff like that are putting on tariffs. So I think the likely outcome is we will see some kind of announcement here in the coming weeks to months where China will announce a very loose monetary and fiscal policy to stimulate domestic demand for metals.
Okay, let's talk about another trend that we're seeing in the mining sector, inflation and rising costs. Of course, that has impacted all businesses. Mining sector has been no different. Are you seeing signs of those pressures easing?
We are. So if you think about the energy markets, where oil is today versus where it was a couple of years ago, the energy costs have come off. A lot of the inputs like the chemicals, the explosives, those pressures have come off. The one area we continue to see pressure is on the labor side. Labor, particularly in markets like South America, we have seen increases between 5 and 10% kind of a year over year. So the labor side continues to be sticky. People don't like to see their wages cut, as one can imagine. But there are some offsets to that as well. We have seen the Mexican peso, which is obviously Mexico is very important to the silver industry. Chile, the Chilean peso has also gotten weaker in the last little while, the Brazilian real. So a lot of these kind of local domestic currencies have weakened relative to the US dollar. And for companies that report in US dollars, all of a sudden their costs, labor costs, have declined because they're basically, when we convert that over to US dollars. So that's been a bit of I think a tailwind of late for guys who have operations in those kind of jurisdictions like Chile, Brazil, and Mexico.
Okay, let's talk about some of the other trends that we're hearing. Obviously, uranium, rising demand for nuclear power has also been a big theme. What's your outlook as we head into 2025?
Yeah, no, we've seen quite a transformation in the last few years. We went through a period of almost 12 to sort of 15 years. We're in the bear market post Fukushima. In the last couple of years, we've come out of that, and we've seen uranium prices move from sort of the high teens to peaking at I think $107 a pound in February. The spot prices have pulled back, but I say the market sentiment, the interest in the space hasn't cooled at all. You would have seen a couple months ago, there was the announcement between Microsoft and Constellation Energy for the restart of the famous 3 Mile Island plant that was been sitting idle for the last few years on care and maintenance. So the plan is to restart that asset in a couple of years. So that's really been a major driver for the positive sentiment and momentum that we've seen in the industry. So in the last couple months, I think the equities that we cover, the big ones that are relevant to investors here in Canada, like UEC, Cameco, NextGen, Denison, are all up north of 50%. At the same time, the spot uranium price has been relatively flat. So we've seen it kind of stuck in that high $70 a pound range. I think going into next year, the market for uranium, the actual supply demand is quite tight. So any upward pressure, any upward demand triggered by some of these issues around supply disruptions from Russia. The U.S. have obviously banned the import of Russian material. There are some waivers that are in place for that, but then the Russians have counteracted with their own ban to exporting material to the U.S. So anything that kind of spurs additional demand, whether it comes from the financial players like the likes of Sprott, who have been pretty instrumental in the last couple of years buying up pounds in the market. If we see some more incremental demand come from the retail space or from guys, the financial players like Sprott, given how tight the market is, the uranium price could rally quite quickly. It's a small market relative to copper, so any kind of incremental dollars that flow into space can have a pretty outsized impact on the price of spot for uranium.
Okay, so let's talk about some of the companies in this space. Of course, we've just gone through earnings season. How are they set up heading into next year? And what's your general expectations on performance of this sector?
Yeah, so there's some very specific catalysts. Maybe I'll start with some of the developers like NextGen and Denison. Both recently got approval essentially for their environmental impact assessments. The next stage for those two companies is get federal sign-off. There's the CNSC, which is the Canadian Nuclear Safety Commission. We'll most likely have a hearing set for mid-next year, where the companies will look to have their mining licenses and EAs approved at the federal level, and that will set the stage for them to start building those projects. So those are major milestones for the companies. They've been working on de-risking these assets for close to 10 years, so we're getting very close to seeing that kind of final decision. So those are a couple major catalysts for those guys to look for in the next 12 months. UEC is a company that's starting to ramp up production in the United States, and they're looking to layer on more production. So the catalyst for those guys will really be centered around milestones in terms of delivering on the production. And then Cameco, it's sort of a steady state situation. They own two of the best assets in the world, McArthur River and Cigar Lake, two of the largest assets, both located in Saskatchewan. So they are continuing to execute on those projects. They've been pretty adamant that they have no plans to bring on any new additional supply unless they get the contracts that they're looking for. So what they do is they layer out contracts for the next 5 years. Right now, they have contracts for almost 30 million pounds for the next 5 years. So as the demand starts to pick up and they start adding to those contracts, they'll look to either expand McArthur River or bring back some of their tier 2 assets that they have sort of sitting there idle right now.